final expense perspective, Brandon, can you once you get that going, can you hand these out? I've got some, I used to have this on a PowerPoint thing, so I had to print some of these out, but we'll go over it. Now, again, this is the final expense focus for me. You know, we're final expense entourage. We love mortgage protection. We're not hating on it. But when I go into a house and we're talking to somebody about final expense coverage, one of the things that we are selling is the guarantees. Okay, look, you know, this is not, we're not worried about, you know, paying off your mortgage here. You're going to die. It's going to happen. It is a guarantee, okay? And so we need to use a guaranteed product to do that, okay? I just give that up front so when I start bashing on the term and the UL policies, you don't think that they're bad. There's a place for them, but not for a final expense prospect, okay? If they're a final expense prospect, if they need something, they need a small whole life policy. Period. End of story. So if they don't have that, I'm going to get rid of it, okay? So why do we need to do policy reviews, okay? Normally, half the people you run into, they're already going to have insurance, okay? And 95% of them are not going to know what they have, okay? They're going to, oh yeah, I got $10,000, I'm paying $22 a month. No, they don't. Okay, so you know, one of the things you're going to have to do is you're going to have to get the policy. You're going to have to find out what is going on. If you're not doing these policy reviews, you are going to leave money on the table. We talk about Brandon writing $400,000 a year. Okay, there's a good probably 150, 200,000 of that where he is replacing, you know, very expensive policies, term policies, just policies that are not a good fit for the client, all right? So, you know, anytime, you know, when you're starting to do, you know, a policy review, you know, we hear, oh man, they got that expensive, you know, Lincoln Heritage policy. Man, we go, you know, we get like that, the Doberman, we're going after it. Well, you got to slow down, okay? If you haven't built up the trust and the credibility first, then you're going to get to it too early. And they don't, no, I don't trust you yet, okay? And so, you know, this is just something small. This is free. You know, you find out that they've got a policy. I always say, well, you know, most of my clients, they either, you know, they put it on top of the refrigerator, or they put it in the closet. Where do you put yours? Now they're going to tell you, just move on, okay? Because you don't do, so remember, anything that you want to do with objections, you want to what? How do you want to overcome an objection?
With a solution.
Yeah, but I always want to overcome an objection before it comes up. Okay, so if you've ever tried to say, well, you've got a policy, can you go grab that? Well, now remember, these are final expense prospects. They're professional procrastinators. Well, I don't feel like getting up right now. Well, Miss Mary, you didn't know you were going to get a workout today. Yeah, go ahead and go grab that. But rather than just dealing with that, I'm going to deal with this beforehand, okay? Oh, you know, so where do you put yours at, Miss Mary? Oh, yeah, I've got it on the table over there. Okay, great. And then you go on. And then later, oh, you said your policy's on the table over there. Why don't you go grab it? I'm going to look down and just wait, okay? But you want to find out their why when you're early on in your presentation, okay? Because that's going to answer a lot of things, right? Because if we find out they want to cover, you know, their death, then if we find out they got a term policy, now we know why, all right? You know, but when you go in there, don't always just be gung-ho to go after that policy. Sometimes just answer, you know, solve this problem that you know, give them the solution. They wanted to add on to what they had. Okay, great, let's add on, and then let's come back. You know, while I'm here, let's take a look and see what you got, Miss Mary. You know, I can offer you a free review, and we'll just take a look at it, make sure there's no mistakes, because we don't want to, you know, we don't want your kids not to get that money because, you know, your name was misspelled. You know, that last guy, he might have just been after your money, and he might have just wrote it down real quick, and we don't want to, you know, so let's just take a look at it real quick. If you've already closed a sale, they already like you, they already trust you, they'll go grab it. But sometimes that policy will get in the way of you selling them something, okay? And then we're just going to have to deal with it right then and there, okay? So when we do go and get that policy, we're going to need to get a few types of things, okay? We're going to need to find out what type of policy it is, right? There's only a few different types out there. There's accidental, there's going to be universal, term, or whole life. Now, with each different type of policy, you're going to need a little bit of, you know, some more information. Now, you know, accidental, obviously we know what that does, right? It just covers in case of accident, death, or accidental death or dismemberment. So, you know, like, look, Miss Mary, if you get hit by a bus, or you get hit by a bus and like 2 of your legs fall off, okay? That's the only time this pays out, right? Now, they may not believe you. No, I got $500,000. I'm paying $999. Well, let's take a look. Something doesn't sound right there. And show it to them in their policy, okay, so that they can see it, because they may not trust you yet. And then get the company on the phone. So I'll do this. I can't find my policy. Sometimes these people really don't have their policies, right? And so we got to call up. Okay, and I don't ask. I go, okay, well let's just call them. You got Mutual Omaha? Sorry, Mutual. We're going to call you up and see what's going on, right? And we're going to find out. We just start dialing and get the company. Now, Miss Mary says that the agent that sold her this, that she's got whole life. So she's got whole life, right? No, she's got accidental. What? Really, be theatrical. What? You said what? She said it was whole life. She's paying $9.99 for $500,000. So it's what? And because that's called creating a wedge. Okay, you want to create a wedge between them and the other company. So you got accidental. Then you got universal life. Okay, you'll see this. This is flexible premium life. You'll see lots of things. There's a number of things you got to look at. Now, universal life can get complicated, and for a final expense prospect, these are horrible policies for the most part, because they were set up like in the 80s and 90s when interest rates were all over the place, and it looked like they were going to last forever. Well, they don't have agents that come out and check and make sure that it's set up right anymore, and so eventually they're going to get to a point where it's going to explode. If you got that, look at that first graph on that piece of paper that I handed out. This is kind of how a universal life product will go if it's designed incorrectly, and most of them that have are. So you'll notice, the premium there. All right, so they'll keep the premium the same the whole time, right? Because they're not going to come by and start increasing. That's that line that goes across. All right. Now, as time goes on, your cost of insurance is going to go up, and that's that diagonal line. You see that one going up there? All right. So as time goes on, as they get older, the cost of insurance is going to go up. Now, before, the cost of insurance is below the premium amount. All right, is everybody following along with me? Okay, so in that case, what happens to that extra money if it's less than the cost of, or if it's less than the premium? It becomes cash value, right? And so the cash value starts to go up, and so you see that little curvy part of the only curvy line on there. Okay, so as time goes on, you see that cash value is growing. That's great. Okay, but when the cost becomes greater than the payment, where are they going to come up with that? The cash value, okay? Now, if it was set up correctly, that would never happen, or they would have their agent come by and, say, hey, you need to start increasing your premiums. But this doesn't happen with this type of prospect, okay? And so what happens is we call these, they're exploding ULs, okay? So what's going to happen is as the cost of insurance keeps increasing, their cash value is going to crash. When that cash value hits zero, guess what also hits zero? The policy, okay? And so it's gone. And so many times you're going to run into people that have a universal life policy at different stages, okay? They might have it where the cash value is increasing, and that's great. Look, Miss Mary, we can show you what's going to happen here. Look at the next slide. This one, I don't know, I found this online, but this gives you an idea. Remember, what are we selling when we're selling final expense? Guarantees, okay? That's all I care about. I don't care about projected. I don't care about what it might be. I want to know what the guaranteed death benefit is always going to be. So I can go on there. If you look down, we'll start at the far left. All right, you got policy here, 1, 5, 10, annual premium. None of these numbers are accurate for whatever we'd really run into. But you see the annual premium is always the same, right? And then you see the guaranteed cash value column, and then you see the guaranteed death benefit. Then you've also got non-guaranteed cash value and non-guaranteed death benefits. And in these situations, the insurance carrier is saying, based on our projections, this is going to go to there. I don't trust, no offense, Mutual, I don't trust insurance companies, okay? I don't trust the man, right? So, and neither are people, right? They don't trust the man, so they'll get this, right? And you just say, look, all I can tell you here is that for sure that you're only going to have a guaranteed cash value to year 30, and then right after that, it's going to explode. And many times when we get down there, we can show them, well, look, this is only guaranteed for another 6 years. And then this is just going to disappear on you. And, you call on the insurance company, and that's what you're going to have to do. Sometimes when you're doing a universal life replacement, it's going to be a 2-call close, okay? You're going to have to, sometimes you can call them, you can get them to fax you in the illustrations, and that's what you're going to need. You're going to need 2 different illustrations. I always ask for one illustration. How long is this policy guaranteed to stay in force based off the current premiums, okay? How long? Is it guaranteed? Don't let, the projection is, you call them up and, well, it's projected to 105. I don't care about projections. How long is it guaranteed, okay? That's what I want to answer. All right, and then the other illustration is how much would we need to increase the premiums to have it guaranteed to age 100. Most universal life policies, they make it to 100, they just, they're always going to stay in force, okay? So that number is usually really crazy high, right? So they're going to say, okay, based on the current premium, it's going to stay in force for 7 years. Okay, all right, well, what do we got to increase it to? They're paying $50 a month for this $50,000 UL. What do we need to increase it to? And they're going to like $250 a month. And then Miss Mary's going, I can't afford $250 a month. Okay, well, that's all right. We'll take care of that. All right, and so now, this policy isn't going to work. Okay, so now let's take the cash value out of it's there. Maybe we'll roll that over into a single premium, right? Maybe buy them a little bit there. And then take the monthly premium that they're paying now, plus whatever extra they can afford, and roll it into a whole life policy. Okay, and so you'll run into those. It depends on what your I don't know. I would always maybe replace a universal life policy once every month or two, so you don't run into it a lot. But hey, if you're able to go through this, and if you ever need help, just if you don't understand what you're looking at, just get the illustrations, share it with Mike, share it with me. You can contact me. I'll walk you through it. Next type of policy, and you'll run into this a lot more often, is where they have a term policy. Okay, and there's a lot of different types of term policies out there. There's level term policies. That's what we sell on the mortgage protection side, right? They get a 20-year term, 30-year term, all that type of stuff. But even if they got that, some agent came in and said, oh, well, you can get a lot more face amount, if you buy this term. And they sell them a Mutual Term Life Express for, 20 years. Well, look, after 20 years, what's going to happen, Miss Mary? You're 65. Okay? You're going to be 85 years old. I promise you're not going to be healthier than you are now. Okay? You're probably not going to qualify. Okay? And then sometimes I'll show them. I'm like, look, at 85, you're going to want to add a $15,000 policy, and it's going to cost $672. I'll just show them on the quoter. I'll just pull it up, right? So those are usually, those are easy replacements, but, a lot of that goes into the presentation. If you look at Brandon's presentation, he's going to show them, the differences between term and whole life, and he's basically going to build up whole life, and this is the greatest thing since sliced bread. Hey, Miss Mary, now, if you had to pick one of those, which one of those would you choose? Oh, well, I'm picking the whole life, all right? So we've already overcame that objection, or if we find out they've got a term policy, oh, remember when we were talking about, the difference between whole life and term, and you said, I want whole life? Well, you've actually, they got you, they got that fine print on there, and this is one of those term policies. So you'll run into the level term policies, State Farm, MetLife, Primerica, that's what we usually run into out there in the field. Premiums are level during the term, and then once the term is over, whatever it is, the rates are going to skyrocket. Okay, and so we just show them, man. It is great. Okay, so see, it's $50 a month, $50 a month, $50, and look at number year 11. Okay, now it's $322. Look at year 12, $680. Can you afford $684? Okay, well, we need to find something that's more affordable for you that's just going to stay in place. And if you explain it to them that way, look, and I love this. Less than 2% of term policies ever pay out. Okay, Mutual, is that right? Less than 2% of term policies ever pay out, right? Yeah, that's what they say on when you do your state exams. I read it one time. So, yeah, it's right, 2 to 3%, okay? It's the big money makers. We get it, okay? I mean, we understand that. Now, it's not like whole life pays out that much greater because these people don't keep the policies for that long, but that doesn't matter, okay? It's just what it is. Once the term ends, yeah, we talked about that. So then I've got, you can look at it, but you can look at the next page. It just shows you a 10-year level term. And you can see there in year 11, well, you see 1 through 10, the premium was $158, and then it just jumps. Okay, that's easy. You'll run into those type of policies, but you don't run into them too much. What you're really going to run into are Globe Life AARP. Okay, these are called like 5-year band increasing terms. So, it's going to have one rate at age 50, it's going to jump up at 55, at 60, 65, and then it's going to cancel at 80 or 90 depending on which one. All right, and so then you're going to want to show them that. All right, so you're either going to get their policy out and show it to them in their policy, or you call into the carrier, right? And you say, okay, so now Miss Mary thinks she's got a whole life policy that I just wanted to make sure this is whole life and AARP. No, it's actually term. oh, it's term, so, but it's gonna last forever, right? No, but the price is gonna stay the same? No? Okay, and then I'm gonna write this down for them, and I'm gonna say, well, what's it gonna go up to? Well, they're paying $50 a month now, and then what's it gonna go up to next? Well, $75. Okay, what's it gonna go up to next? $112. You keep going, right? All the way up to 80, where it's showing them, $385. Now, you gotta be careful with AARP. They'll be like, well, they can start converting it there. Don't let them go that far. Just, I understand how term conversions work. Yeah, thank you. We'll get back to you, all right? Just hang it, because I'm replacing the policy, okay? Not AARP is not gonna convert it, okay? So, but you want to look, right? This is my business, okay? I'm going to make some money. Okay? AARP should have converted it earlier. All right, but that's what you're going to run into out there. And so, I mean, you're running these all the time. When I first started, I struggled, man, because, I'm trying, they got this, $10,000 policy, and they're paying $23 a month. This is supposed to be a K. And then I'm going to show them, another $10,000 policy in its whole life, and it's $50 a month. How in the world am I going to replace that? Well, again, it's all about value, right? I can show them why this is better and why this is going to stick around and how that one is going to go away. And I can show them how that one's 23 now, but it's going to be 50 in 2 years. Miss Mary, you're already paying $50 a month. Actually, you're already paying $75. Actually, you're going to be paying one. Can you afford $112? No. Can you afford $75? Yeah, I can probably swing it. Well, you know what? I can get them for $75. I can get them more than $10,000. Now I just captured all the premium plus more. And that's a trick too. Whenever you're replacing, you want to capture all the premium, okay? Look, this just sounds better, okay? If I can save them $5 a month, whoop-de-doo. But if I can get them $2,000 in insurance for free, that sounds better, right? And our folks, they love getting something for nothing, okay? You tell me, well, Josh, you're one of those people that wants something for nothing. I get offended, that's not me. But our final expense prospects, man, they pride themselves. I'll say it to them. You want something for nothing, right? Yeah, that's what I want. So that's what I do. And that's how we show it. And they love it. They love it. All right, so
you didn't say you did stand up.
All right, where are we at? Okay, so then the next thing you're going to run into, I don't know how to do this one without being there. So mutual, plug your ears. So you're going to run into these graded modified products, okay? So say somebody goes out there and they only have Prosperity, okay? And so, they run into somebody, they got diabetes with, very strong neuropathy, and so they have to go modified. Well, Prosperity, the reason they don't mind you selling the modified is because it's super expensive. And I don't care because it's full commission, so I'll sell it if I need to. But, it's expensive. So when I run into that guy that's got Prosperity on a modified, and his only problem is insulin and neuropathy, well, I'm going to go Royal Neighbors. Okay, because they don't care about diabetic neuropathy at all. Now, he's got this 2-year waiting period until his insurance policy goes into full effect. Well, I'm going to get him twice the face amount and first day coverage, okay? And so you're going to run into this a lot. And what you run into is the Mutual Omaha, it is their graded, which is really a return of premium. They don't let us sell it because they know we'd only sell it to the sick people, right? So they only sell it through the mail, so they get all those people. But that's fine, I don't think they, we'll see how they like that afterwards. But yeah, so you'll run into that. You'll run into Physicians Mutual. What else do you run into out there that's modified 2-year wait? What else you run into out there, Brandon?
Those are the main ones.
Yeah, so whenever you run into them, you just show it. Now, so what I do in those situations is I'm going to tell them, we want to do an apples to apples, because they're going to I got $10,000. Well, you don't have $10,000 today, right? Because, okay, if they're paying $100 a month, and it's a return of premium plus 10%, all right? ROP plus 10%. And if they've had it for a year, if they died today, how much are they going to get?
$110.
After 12 months, he said?
After 12 months.
Yeah.
1,200 plus 10%.
$1,320.
That's right. So we do this times 12, right? So we got 1,200, and then 10% of that is 120, right? So we're at 1,320. All right? Miss Mary, if you died today, your daughter, who, this is why you got this insurance policy, right? So she could take care of your final expenses, is only going to get $1,320. Now, maybe she's unhealthy. Maybe she's got COPD and, she's 400 pounds and, she got some problems, all right? Well, what am I going to do? Well, I go look up and, she's paying $100 a month. And the best I can get her for $100 a month is $5,000 in insurance. okay? But that's $5,000 in insurance today, okay? And I'll replace that all day long. Look, Miss Mary, I can get you, right now, if you die today, you're only getting $1,320, all right? I can get you instant, it'll be worth $5,000, okay? And just show them that. Show them the numbers, okay? So you'll run into that. So when you run into a graded or modified, look, our job is to do what's in the best interest of the client, right? We want to get them, and in my opinion, the best interest is selling them first day level coverage, number one, okay? If I can't get them first day level coverage, then I'm going to go to like a 30-70 graded, then I'll go to a modified, and then I'll go to guaranteed issue, okay? But if they've got a product and I can, replace it with something that has first day coverage, I will, all right? And then sometimes you're going to run into a situation where somebody has had a policy for a long time, okay? So I got an example. I'm going to put it up here. We've got a 65 female non-tobacco. You see that? FMT, all right? All right, if it was male tobacco, what would we write? MT. All right, so you ever see me writing that somewhere? I got 3 minutes? There ain't no way I'm going to get through that in 3 minutes. All right, I'll go as fast as I can. All right, she's got a $15,000 policy, and she's paying $50 a month. And she got this back when she was 60, so she's she's built up a little cash value. All right. Now this is not real, so I just made these numbers up. So it's worth $2,000. Now the best I can get her right now is a Mutual Omaha policy. See, I love you guys. Did you disagree on me? All right. I can get her a Mutual Omaha policy for $15,000 for $59. How in the world am I going to replace that? Okay, I mean, I can't just sell her, something for more expensive. I mean, I could, but that would probably not be right. Now maybe I just add on, and that's what you'll find. You'll go into these houses, and you'll see they got a Forrester's policy, they got a Transamerica policy, they got a Lincoln Heritage policy. When I walk out the door, they got one policy, and it's with me. All those are gone. All right. But then, and that's a little complicated, but, I'll give you just one example. Now, there's another number. Whenever you're looking at these table values, okay, it's going to show you the premium, it's going to show you the face amount, it's going to show you the cash value, and what that is if they just surrender the policy, they're going to give them no insurance, but they're going to give them $2,000 cash, right? What's another value that's on there?
Surrender value?
Well, that is the surrender value.
Paid up edition.
Paid up. Reduced paid up, all right? RPU. Not always, but usually it's about twice as much as the cash value. Not always, but it just depends on the carrier. All right. So now we've got something to work with. I can just tell Miss Mary, I can do an either/or close. I can say, look, Miss Mary, maybe she needs some money. Okay. Sometimes that's good enough. She said, look, my car is broken. My kid's in jail. I gotta go bail them out. This is real. This happens, right? And she says, I need that $2,000. I didn't know I was there. Well, I was like, well, look, I can get you a Mutual Omaha policy. Pay a few bucks more a month. You'll get $2,000 in cash. Okay, let's do it. All right, that's easy. Okay. Sometimes you'll find it where you can actually still beat the price and still get them the cash value, and those are the easiest ones, right? But tell her, she said, no, I don't need the money. Okay, I need more insurance. I just need a little bit more insurance. Well, $12,000 costs $48 a month. If we surrender this policy and convert it to a reduced paid up, she'll have $4,000. Then she'll have we can sell her a new policy for $48, which is a couple bucks cheaper. 4 plus 12 is how much?
16.
She ends up with more insurance than what she started with, and a couple bucks cheaper a month. And so I give them both options, right? You can take the cash, pay a few bucks extra, or we can get you, $1,000 in insurance for free. Okay? So make sure you're doing that. That'll get you an extra sale a week, okay? Because you will run into this type of stuff all the time. All right? Any questions? I got to wrap up. I'm getting the clock.
No, you're not.
Oh. Any questions? No? Yes? No? All right. Thanks, guys.